what are you seeing from the perspective of the sales you're doing in terms of the asset classes and how those have been impacted? And maybe the most obvious one right now is the shift that office is going through. And I'm sure New York is feeling a lot of the same things the other major markets, other cities in North America and the world are feeling. So what are your thoughts on that?
Yeah, well, Jesse, I think this is now the fifth correction that I work through. And I will tell you the main difference between this one and the previous four are that in the previous four, every product sector was getting hurt just to different degrees. Today, I think different market segments are moving in different directions. In New York, the industrial market is extraordinarily small, but is doing relatively well. The retail market is on the upswing today, but retail started to get negatively impacted years before the rest of the market did. The land market is starting to turn the corner. We're starting to see some upward pressure on land values. And if you look at the multifamily market, however, which is the biggest sector of the market in terms of number of buildings, we have significant policy headwinds in that space and big changes within that arena. And then the office market you mentioned, still lots of wood to chop there. You have to differentiate between Class A new construction office, which is still doing relatively well, but B and C office is really, really having a tough time. And on one hand, I think it is the biggest buying opportunity I've ever seen. Even more so, in my whole career, I used to say the savings and loan crisis was absolutely the best buying opportunity. And there are a lot of people who made fortunes at that time. And in the same way, I think those same fortunes can be made now. And people say to me, "Oh, Nackel, you're a broker. Of course you're going to say that." Well, at the same time, I'm telling every single seller not to sell unless they absolutely have to, or they have a very compelling strategic reason to do so. But it's really remarkable. We have buildings selling for the same prices per square foot that they were selling for 20, 25 years ago. A lot of people, unfortunately, are going to get hurt. A combination of the interest rate increases that we've had, which was precipitated by a complete misdiagnosis by the Fed of what was happening in the market, but disproportionately has adversely impacted real estate. And the fact that there are a lot of people who have debt on their buildings at twice the price per square foot that buildings are trading at today. And it's tough to get out of that because, when you have 400 a foot in debt and your competing property across the street is selling for 200 a foot, it's very, very difficult for you to compete for tenants. And so we have in New York in that B and C space, I think some of it will be renovated and upgraded because there has to be a low-cost provider of space. Every office tenant can't pay $250 a foot in a new building. And some of it will be converted to residential, and there's been a big push for that. And we sorely, sorely need housing in New York and have way too much vacant office space, close to 100 million feet of empty office space. So that is a synergistic relationship. But then based on where some of these buildings are trading, even if you layer in demolition costs, then you're going to see a lot of these buildings demolished to make way for new construction. So the B and C office are falling into one of those three buckets.